Visit AnyExpat for relocation assistance.
Dubai, the city of gold, of towering skyscrapers and extravagant dreams. But what happens when that dream starts to crack? In just a few days, a staggering $250 billion was wiped from Dubai's stock market. Is this just a minor blip on the radar, a buy-the-dip opportunity for savvy investors? Or is it the first tremor of a catastrophic property crash, a repeat of the 2008 nightmare that brought the city to its knees? Stick with me because today, we peeling back the layers of luxury to find out what is really going on in the heart of the desert metropolis. First, let's set the scene. For the past few years, Dubai has been on an absolute tear. While the rest of the world grappled with economic uncertainty, Dubai's property market was booming. Prices soared, luxury villas were selling for record amounts, and developers were launching new, ambitious projects left and right. It felt like the party would never end. The city became a magnet for the world's wealthy, seeking a safe haven for their cash, a tax-friendly lifestyle, and a piece of the glamour. The numbers were staggering. In 2023 alone, the market saw transactions worth over $160 billion. That's a huge jump from previous years, so what suddenly changed? Why the massive sell-off? The trigger for this recent panic wasn't a single event, but a cocktail of global and local factors. Let's start with the big one: global interest rates. Central banks around the world, especially the US Federal Reserve, have been hiking rates to combat inflation. Since the UAE's currency, the dirham, is pegged to the US dollar, their central bank has to follow suit. Higher interest rates mean higher mortgage costs. Suddenly, buying a property in Dubai became a lot more expensive for the average person. That dream of owning a home with a view of the Burj Khalifa started to slip further away from many. This immediately put a damper on demand, especially in the mid-range market. Then there's the geopolitical situation. The ongoing instability in the wider Middle East region always makes investors a little nervous. While Dubai itself is a beacon of stability, regional tensions can have a ripple effect. Wealthy investors, many of whom poured their money into Dubai as a safe harbor, start to get jittery. They might begin to pull their capital out and move it to places they perceive as even safer, like Singapore or Switzerland. This capital flight, even on a small scale, can shake confidence in the market. When big players start selling, smaller investors often panic and follow suit, creating a domino effect that we just saw on the stock market. But let's not forget the local factors right here in Dubai. There's a word that sends shivers down the spine of any Dubai property veteran: oversupply. For years, developers have been building and building and building new towers, new communities, new man-made islands. It's part of Dubai's DNA. But this relentless construction raises a crucial question. Is there enough demand to fill all these new properties? In the past, the answer was a resounding yes. But now, with affordability becoming an issue and some international demand cooling off, we might be reaching a tipping point. Some analysts are warning that we're seeing a flood of new units hitting the market just as demand is starting to soften. It's a classic supply and demand problem. When supply outstrips demand, prices have only one way to go: down. Let's talk about that $250 billion figure. It's a headline grabber for sure. But it's important to understand that this refers to the stock market, specifically the market capitalization of listed companies, many of which are giant real estate developers like Emaar. When their stock prices fall, their market value plummets. This doesn't mean $250 billion in cash literally vanished from the property market itself. However, it's a massive indicator of investor sentiment. It shows that the big money, the institutional investors, are worried about the future profitability of these real estate giants. They're betting that the boom times are over, at least for a while. Their fear is that future sales will slow down, projects will be delayed, and profits will shrink. This lack of confidence in the stock market can easily spill over into the actual property market, creating a self-fulfilling prophecy. If people believe prices will fall, they'll stop buying, which in turn causes prices to fall. So is this 2008 all over again? To answer that, we need to remember what made the 2008 crash so devastating. Back then, the market was fueled by pure speculation and incredibly loose lending practices. People were flipping properties off plan, sometimes within days, for huge profits. Banks were handing out mortgages to almost anyone. It was a classic bubble. When the global financial crisis hit, credit dried up overnight, and the whole house of cards came tumbling down. Prices fell by over 50%, and the city was littered with half-finished, abandoned construction projects. Is today's situation the same? Not exactly. The Dubai government and the UAE Central Bank learned some very painful lessons from 2008. They've put much stricter regulations in place. For example, there are now limits on how much you can borrow based on the property value, known as loan-to-value ratios. There are also higher transaction fees like the 4% Dubai land apartment fee, which discourages the kind of short-term flipping that fueled the last bubble. The market today is arguably more mature and less speculative. A larger percentage of buyers are end users, people who are actually planning to live in the properties they buy, rather than just speculators looking for a quick buck. This provides a much more stable foundation for the market. Furthermore, Dubai's economy is much more diversified than it was in 2008. While real estate is still a huge pillar, sectors like tourism, logistics, technology, and finance have grown enormously. The government has also introduced long-term residency options like the Golden Visa, attracting skilled professionals and wealthy individuals to make Dubai their permanent home, not just a temporary investment playground. This creates a steady, organic demand for housing that wasn't there to the same extent 15 years ago. So, where do we go from here? We're likely entering a period of correction, not a full-blown crash. The days of 20 to 30% annual price growth are probably over. We can expect a softening of prices, perhaps a decline of 5 to 15% over the next year or so, especially in certain areas with a high concentration of new supply. The ultra-luxury segment, the multi-million-dollar penthouses and beachfront mansions, might be more resilient as it operates on a different plane, less affected by mortgage rates, and more by the whims of the global ultra-rich. But the mid-range market, the apartments and townhouses for regular families and professionals, will definitely feel the squeeze. For potential buyers, this could actually be good news. A market correction can bring prices back to more realistic and sustainable levels. It could be the dip that many have been waiting for, a chance to get into the market at a more reasonable price point. However, the key is not to try and catch a falling knife. It's crucial to do your research, understand the specific dynamics of the neighborhood you're interested in, and have a long-term perspective. For sellers, it might be a time to adjust expectations. The days of naming your price and having a dozen buyers line up might be gone. If you need to sell, you might have to be more flexible on pricing. For developers, this will be a real test. The ones with strong balance sheets and desirable projects will weather the storm. But smaller, more leveraged developers might find themselves in serious trouble if sales dry up. We could see some projects being paused or canceled, but probably not on the scale of 2008. In conclusion, the $250 billion shock is a serious wake-up call for Dubai. It is a sign that the market is shifting gears from a period of unsustainable growth to a more sober and challenging phase. Is it a crash? The evidence suggests probably not. The market's fundamentals are stronger, regulations are tighter, and the economy is more resilient than in 2008. However, it's definitely not just a small dip either. It's the beginning of a significant market correction. The wild party is quieting down, and a period of normalization is beginning. The next 12 to 18 months will be critical in determining the new baseline for Dubai's property market. It will be a time of opportunity for some and a period of pain for others. The city of dreams isn't collapsing, but it is certainly facing a much-needed reality check. Thanks for watching. What are your thoughts on the Dubai property market? Are you buying, selling, or just watching from the sidelines? Let me know in the comments below. And if you found this analysis helpful, don't forget to hit that like button and subscribe for more deep dives into the world of finance and real estate. See you in the next one.
Visit AnyExpat for relocation assistance. Don't forget to like and subscribe.